Hello, everyone. Thank you for joining us for this installment of our Business Breaks series. I'm Tamara Carassa, a partner at Reynolds Morris Richards and Farmer, and I have here with me Emma Banfield, one of our associates. Today, we're going to talk a little bit about what happens when your business needs a loan. Taking a loan for your business is not a bad thing, and it's often something that can help your business to get to the next level, whether that's through growth or whether that's through holding you over through a troubling period. The important thing to think about when your business is looking for a loan is that there are different types of risks depending upon the security that is asked from the bank, and that risk will be posed to your business, but also to other interested parties. You'll also need to think about the unique needs of your business and what kind of structure you need the loan to be in order to allow you to proceed with your business, whether that might be draw loans where you have draws throughout a period of time, or whether you need just one loan up front. The other thing you'll want to do is make sure you're thinking about who you're borrowing from and what kind of requirements they need and what the risk is that they're willing to take in loaning to you. With any loan, it's really important to make sure that you've reviewed the loan documentation carefully, and you understand what your obligations are under that documentation. That will govern your interactions with the lender on a go-forward basis, and it'll outline important features like interest rates, payment schedules, and what's going to constitute a default under the loan. So today we're going to talk about 4 common types of security that you might be asked to give when you seek a loan from a bank or from another type of lender. Nearly every business is going to need influx of capital at some point in time, and so it's important to understand what these are so that you are educated when you go to speak with your lenders. Nearly every lender, whether it's a bank, a friend, or another company, is going to expect something in return to ensure that their loan is going to be repaid. Generally, a loan will be repaid with interest, but many lenders want some kind of security for their loan if the business fails to pay the loan back. The purpose of this short presentation is to cover some of the ways in which a small business can secure a loan, and we're going to cover 4 common types of security a lender might ask for: mortgages, general security agreements, assignment of insurance, and personal guarantees. We're also going to touch on some other types of security at the end. So a mortgage is a specific type of security that is an agreement between the lender, often a bank, but not always. You can have mortgages granted by their parties as well, and an owner of real estate to let the lender register an interest in the property on title to that property. The effect of a mortgage is that the land cannot be sold without the lender first getting paid. So if you are looking to sell your property, you will need to pay out the value of the loan before a lender is going to agree to remove its mortgage. And a purchaser of the property is not going to want to take the land subject to that registration. If the borrower defaults on the payments under the loan, the lender has the ability to either take the land or force the land to be sold. And in that way, the lender can get their money back. I'm going to pass it over to Emma, and she's going to talk about general security agreements.
So general security agreements, which are often referred to as GSAs, are a lot like mortgages, but instead of granting an interest against real estate, it's granted against some other type of property that the business owns. So it can be used against tangible assets, so for example, equipment or machinery or inventory, but you can also grant a GSA against non-tangible assets that your company or business might have, such as stocks and bonds or trades or even accounts receivable. So lenders tend to like general security agreements because they let the lender actually physically take something if you default on the loan. So it's something that they can move around, unlike real estate, and it's something that they can sell if they need to. it's risky to the business because it's possible that the business will lose something that they need in order to conduct their business if they default on the loan. So for example, if you need a printing press to run your business and you grant a lender an interest against that printing press, and then you default on the loan even by accident, and the lender takes the printing press, you might not actually be able to run your business without that printing press. So it can be a little bit risky to the business as well. So I'm going to go to the next slide, which looks at the assignment of insurance. So you can insure your business against all kinds of losses. So most businesses will have some sort of insurance, probably against, fire or floods, but you can even insure against a failure of the business. And what it means is that if something happens, if the event that you're insuring against occurs, then the lender can get paid first. So you, in the agreement, provide that if the insurance kicks in, the lender's going to get paid first. And of course, lenders like this, because if the event happens, they know that even if something happens to the business, that they're going to get paid out first. But of course, it's risky to your business because you're only left with whatever additional proceeds come in from the insurance. So there's kind of pluses and minuses that way as well. I'm going to pass it back over to Tamara to talk about personal guarantees.
So a personal guarantee is a promise by an individual to make whole the lender if the business is unable to pay the debt. So the important thing to remember with a personal guarantee is that you as an individual are pledging your own assets, and you're agreeing that if the company defaults on the debt, you will make whole the lender. You will pay the amounts that are outstanding. Lenders like personal guarantees because it means that the shareholders or the individuals involved in the business are putting their personal name and assets on the line, so they are more motivated to make sure that they are not defaulting on the loan. But it is risky because personal guarantees remove the separation between yourself and your company, and it also puts you into a position where you as a shareholder, although you may not have been liable for the debts of a corporation prior to giving a personal guarantee, you are now liable for them after giving a personal guarantee. What this means is that your personal assets are on the line if your company defaults, and you stand to lose whatever it takes to satisfy the debt outstanding to the lender. There are some other types of security that lenders may ask for. They may ask for corporate guarantees. So if you have a operating company and a holding company, they will often ask that the company gives a guarantee, and those function much the same way that a personal guarantee would, but it's just done by another corporation guaranteeing that they will pay the debt and putting their assets and their name behind the borrower. They might also ask for specific security agreements. So when Emma talked about general security agreements, she referred to a printing press. A specific security agreement could just name that printing press in the agreement as the collateral and not apply to all of the rest of the business. You'll often see specific security agreements where there are vehicles or equipment, machinery, and those will be specifically noted in a security agreement and being held as collateral for the lender. Another type of security, another type of loan that you might see is an unsecured loan. And this might mean that there's no security that's going to attach to it, and often there'll be more stringent terms for an unsecured loan and higher interest rates. And that's just the way that the bank or the lender manages their risks, because there's a greater risk that they may not recover the entire amount of the debt. They would ask for something in return, being the higher interest rate and more stringent payment terms. So as we said at the beginning, you know your business and what kind of risk it can handle, which assets are going to be valuable, and what terms your business can undertake in exchange for a loan. You can use that information and the information we provided in this presentation to think about what kind of securities you might be willing to give to a lender and what might best match your business and the lenders available to you. As a reminder, make sure that you're reading loan documents carefully. Your business is going to want to avoid defaulting on any loans. So understanding your business's obligations under a loan are vital. And often there's terms in a loan agreement that are not limited just to the repayment of the funds. There are other obligations that are placed on the business. And if you do not comply with those obligations, you would be in default of your loan. We really hope that this helps to make your business a success and gives you a brief overview of what you might want to think about if you're considering obtaining a loan. If you have any questions, you're welcome to contact myself or Emma, and feel free to look at our website for any additional information and to look at the other installments in this Business Breaks series. Thanks for tuning in.